What about the vision?
Now we get
Is
to
that
the
there?
exciting part where we see if our technology works. So we're trying to connect to Vienna, where our next speaker... see, that seems to work perfectly. Welcome, Dr. Jerome Booth. Can you hear us?
I can. Can you hear me?
Yeah, that seems to work very well.
Good.
Let me give you a short introduction for the people who are not familiar with you. Dr. Jerome Booth is basically one of the founders of Ashmore, where he basically stayed until May of last year, when he decided to pursue his own private office named New Sparta, where he's still managing a number of investments. He's one of the main supporters of allocating more money to emerging markets, which will be an interesting topic to discuss, I assume. And he recently published his first book called Emerging Markets in an Upside-Down World. The floor is yours.
Okay, well, thank you very much. I thought I would talk mainly about some macroeconomic and policy issues. I have been listening to the last two sessions, and I understand you've also had in your first session some content on emerging markets and the shift. So I've sort of my title for my presentation is Deleveraging Banks: Policies and Investment Consequences in Developing and Developed and Emerging Countries. And I've split it into four parts. First of all, the shift to emerging markets, and you've heard some of that already. Secondly, the fact that there is deleveraging in the developed world, but not in emerging markets, and the consequences and some of the features of that. And then a session on the sort of policy responses in the developed world and policy responses, finally, in the emerging world. And because we're running late, I shall try and speak quickly. If there are any questions at the end, please bear in mind that I can't hear anything unless you have a microphone. First of all, the shift to emerging markets. One of the things that the reason I've written the book is actually because I've been sort of grappling with how it is that we've got, on the one hand, this enormous, we've just heard about the statistics, the dominance really in the global economy, and certainly the massive growth of emerging markets. And yet the asset allocation is not skewed that way at all, certainly from developed markets. And I think this really comes down to finance theory, which is very appropriate in a CFA conference. So a large part of what I've been trying to get to grips with is the economics and the finance theory, and where the assumptions that we use have limitations, and what that means for an asset allocator. So this is not an emerging market point. This is a global point. This is a point about how we actually asset allocate globally. And what I'm basically saying is that finance theory is limited by its assumptions, and in practice, this is ignored, and the result is basically the practice of in effect, ignoring things that can't be measured. And this has caused a very significant distortion in global financial flows and investment. And emerging markets is just the best example of this. The prejudices, therefore, are very substantial. And I have a little theory I call core periphery disease. This is the idea that the core, which is Western Europe, the United States, Japan, affects the periphery, emerging markets, but we just ignore the effect of the periphery on the core. And this is a deep-seated meme. It's an intellectual virus. It's not, a small theory. It's something that affects the way we think about the shape of the globe. And it's been with us several hundred years. And it's no longer fit for purpose. So an example would be, a study, shortly after 2008, the IMF did a study on what would happen if there was another major, financial shock, say, in the Eurozone. What would be the impact on emerging markets? And they came up with the conclusion at that point that maybe $15 billion might leave emerging markets. And here we are, the last few months, worrying about exactly that sort of scenario. Core periphery disease is not asking the question the other way around. You've just heard that central banks in emerging markets own most of the reserves in the world. They are the net creditors. my own country, the UK, private plus public sector debt to GDP is over 500%. The average for what I call the HIDICs, the heavily indebted developed countries, is 250%. That is 10 times what it is in the emerging markets, who are actually net creditors. So we've seen in history, as in 1971 with the breakup of Bretton Woods, that in such a crisis of confidence, it's always the creditor nations that pull the trigger. And the consequence, of course, of emerging market central banks pulling out of European and US sovereign bonds is much more significant than the flow the other way. So to answer that, the riposte to that 15 billion is, well, emerging market central banks and sovereign wealth funds alone own about 11 or 12 trillion dollars of just European and US sovereign debt, i.e. the liquid stuff that they could presumably sell quite quickly, although of course they couldn't because those instruments would quickly become illiquid. So we have to really think about macroeconomics and the global imbalances a little bit more than the very simplistic way of thinking about risk. Risk is not the same as volatility. It might approximate that if you're a day trader or if you don't really care about other things. But most people worry actually quite a lot more about other things like large permanent loss. That might be seen as a bigger risk than a bit of volatility, particularly if you're a long-term investor. So there are some basic problems in our terminology, our concepts of risk, and what I've been trying to do, I'm just pointing you towards what I've been working on, is analyse some of those assumptions and what that means for the way that we should think about the world. We also, I think, have to understand the history of 2008. I know you've had a little bit of this earlier. But I see very much the super bubble building up in the US and Europe as a function of two main things. And these are the main theories. People weight them differently. But basically, it's a result of two things. One, an enormous funding by the emerging markets of the developed world. A massive move of capital into US treasuries and other developed world bonds from the emerging markets. And this, in turn, building up reserves in these central banks. And that, in turn, pushing down the entire yield curve in the US, creating a false sense of safety and actually spawning much more leverage and therefore potential danger. Because we have a sort of positive feedback mechanism. We equate low volatility with low risk, and so if something is low volatility for a bit, we think it's less risky, so we leverage it up, and of course we don't notice that's actually made it more risky. Because risk is a function of who's invested. It's a function of how homogeneous the investor base is. The structure of the investor base is an extremely important and widely overlooked factor to liquidity and risk. The other reason for the build-up and the super bubble, of course, is regulatory failure. Bagehot in the 1870s told us how to regulate banks, but we sort of got this laissez-faire idea firmly fixed in our mind, and we stopped regulating banks. And to be fair to regulators, it's become a much more difficult job since the commodification of finance and the massive leverage and banks going public and therefore not self-regulating. But I think that's the setting. We still have, if you like, big imbalances between the debt levels, the huge debt levels in the developed world, and not that in the emerging world. And we've got to distinguish, I think, between the situation which you see when money comes out of emerging markets, as has happened in the last few months, and the potential for something really big. Because if you're a central bank with $300, $400, $500 billion in reserves, what that means is you can affect your exchange rate at will. If you choose not to, because you think you'd rather find out what happens next or save your powder, if you're complacent for whatever reason, that doesn't actually tell you what's going to happen. If you do nothing, as central banks in emerging markets largely have, then one shouldn't necessarily extrapolate from that just because some Western money has come out or is more dominant in markets today, that tells you a lot about the fundamental risks. The fundamental risks, for that you have to analyse the actual balances. Who has what money? Who are the creditors? Where are the big macroeconomic problems? And above all, who has the amount of debt? And that brings me on to deleveraging. And what we're going to see is a huge amount of if you like, means to reduce that debt in the developed world. I'll come on to that in a minute. First of all, deleveraging is important to understand is a developed world problem. And historically, what we've seen is some concerns recently about market